Hi, in this video I'm going to explain exactly how Celsius loans work, mention some key points that are very important to know when taking out a loan, and then running through a few scenarios to examine when it is worth it to take out a loan. As usual, none of this is financial advice, and you should always invest and borrow at your own risk. Alright, let's get started. So here I'm on the landing page of the Celsius website, and I'm on the borrow page. It says that I could borrow at 1% APR with no origination fees, no credit checks, easy refinance options, and lowest industry rates. I do think this 1% is lowest in the industry compared to all the other centralized exchanges. And so I'm just going to go through how borrowing works just using this calculator here. Basically what happens is I'm opening up a collateralized debt position. So for example, I have funds like Bitcoin on the Celsius platform and it's sitting there earning interest. But what else I can do with it is use it as collateral to borrow some stablecoin or to borrow fiat, which is USD here. So if I want to borrow something like $5,000 in USDC, then I would need this amount of collateral in order to get a 1% interest rate. And this 1% interest rate corresponds to a 25% LTV or a loan to value ratio. What that means is what I'm borrowing, which is the loan, must be at most 25% of the value of my collateral. So this amount of Bitcoin would be worth $20,000 to be at this ratio. Now, if I wanted to borrow more, if I wanted to increase my loan to value ratio, I can do that. It's just that Celsius would charge me more interest. And same thing here. If I want to borrow half of the value of my collateral at 50% LTV, then I'll be charged around 9% in interest. I can choose a loan term from 6 months all the way up to 3 years. At 1 year, at these loan conditions, so 50% LTV and this almost 9% interest rate, then I would have to pay about $450 in interest for that 1 year for a $5,000 loan. If I choose the loan term to be 3 years, then obviously the loan interest I will pay will be 3 times as much as the loan interest at 1 year. So that's the gist of how the loan works. So let me just mention a few key points that are very important when taking out a loan. And the first one is if I can repay my loan at any time. So there is no penalty to pay off a loan early, but if the loan is not at least 6 months old, so if I haven't had the loan for at least 6 months, then I will have to pay 6 months of interest. So that's the minimum amount of interest that I'll have to pay for the loan. And then the second thing that is probably even more important is for the collateral that was earning interest on Celsius. So for example, if I had deposited Bitcoin on Celsius, I'm hopefully earning about 5% back in APY per year. If I use that Bitcoin as collateral, then the interest is not being earned and I'm not getting any rewards back from that deposited Bitcoin. So that is very crucial when determining if it's worth it to take out a loan against your collateral. The last important key point I want to talk about is just margin call or liquidation. And what that means is basically if you put collateral up to take a loan out, if the value of the collateral drops to a certain threshold, then Celsius will take that collateral and sell it to repay the loan. That means you lose your Bitcoin or Ethereum or whatever you used as collateral. I'm not going to talk too much about it, but you can read about margin calls and liquidation on this page here. I'll leave a link in the description below. Okay, so let's take a look at a few scenarios in which I examine whether or not it's worth it to take out a loan on Celsius. So in this first scenario, imagine that I have a Bitcoin balance in Celsius of 0.66 and that the current price of Bitcoin is at $38,000. This results in my balance being $25,000. And currently on Celsius, if I have a Bitcoin balance of less than 1 Bitcoin, then I earn 5% on that Bitcoin. Here I'm assuming that the end price of Bitcoin or the price of Bitcoin after a year, which is what I'm assuming my loan length will be, the price has stayed the same in a year for Bitcoin. So applying that 5% to my 0.66 balance, my yearly earn in Bitcoin is 0.033-ish Bitcoin. And converting that to dollars, that means it's $1,250. And I'm using this Bitcoin end price value to calculate this yearly earn number. That means that I have a return on investment of 5%. So let's see if it's worth it to take out a loan for this scenario. And in this scenario, I am using the loan to deposit on Anchor Protocol. Anchor Protocol is just a DeFi savings account that is on the Terra network. If users deposit on Anchor, they can earn 19.5% on the UST stablecoin. So it's basically like earning almost 20% on a USDC balance. So in this first scenario, imagine that I've borrowed 25% of the value of my collateral. So that means my loan APR is 1%. So the interest charged on my loan is 1%. The collateral that I'm putting up is worth $25,000, which is my Bitcoin. And then so the maximum loan amount I can borrow is $6,250. So going through the math, if I deposit that $6,250 on Anchor, then I come out with $1,218 per year. That's how much I earn based on this interest rate. If I subtract out the yearly loan interest, which is $62.50, then my total profit from this scenario is $1,156. If you notice, the difference between what I earned on Anchor and what I earned just leaving my Bitcoin on Celsius is negative. So that means this strategy is not worth it. I'm better off just leaving my Bitcoin on Celsius earning the 5%. This return on investment is less than this return on investment. So therefore, I should keep my Bitcoin earning on Celsius. Let's see what LTV I actually need so that this strategy becomes better than just leaving my Bitcoin in Celsius. So I'll just highlight all these cells and then copy them. And so for the LTV of 50%, I finally have a positive number here. That means I'm earning more on Anchor than I would have on Celsius. And so you see this return on investment is 5.3-ish%, which is larger than this. So this is the better strategy. But that also assumes that Bitcoin didn't change in price during the time that I took out the loan. So let's imagine that it increased in price to 45,000. What that does is that it makes all of these strategies, no matter the LTV, negative. So that means depositing on Anchor is not better than just leaving my Bitcoin in Celsius. What happens if Bitcoin in the duration of the loan drops in price? Let's say it drops down to $25,000. Then all of a sudden, all these strategies become better than leaving my Bitcoin on Celsius. All these return on investment percentages are larger than this one. So it really depends on how the Bitcoin price action is moving within the time that I take out the loan, and also depends on this interest rate as well. If Celsius decides to decrease this, then maybe it's more worth it to deposit on Anchor, or if they try to increase it, then that means it's better to leave it on Celsius. That's it for this scenario. Let's take a look at another scenario that could be a potential usage for the loan. So in this scenario, instead of depositing my loan onto Anchor to earn a stable yield on stablecoins, I used the loan to buy another crypto in hopes that it appreciates in value. So these parameters are pretty much all the same as the previous example. And the alternative would be to take out the loan, and my loan amount for this LTV would be at $6,250, and instead use that to buy another crypto. Let's say AVAX or the Avalanche coin. And let's say that I purchased it at $70 and then I ended up selling it at $100. So that was a gain that I made using this loan amount. And the total cash from that sale on the Avalanche coin was almost $9,000. So accounting for interest on the loan, I profit $2,616, which if I compare it with just leaving my Bitcoin on Celsius, that is a difference of almost $1,400. In this specific scenario, my return on investment is about 10.5%, which is double what I would get on Celsius. So in this scenario, I'm much better off taking out a loan and then betting on the appreciation of the AVAX coin. But of course, this is risky in itself. We don't know if AVAX will actually gain. It might go down. There's also still the unknown of the price of Bitcoin at the end of the loan term. If this increases in price, then this becomes less profitable. And then let's see what happens if I increase the LTV. As I borrow more and more from my collateral, even though the interest rate increases, I'm getting a lot more back in profit here. and it's doing much better than just leaving my Bitcoin in Celsius. These are the return on investments as my LTV goes up as compared to leaving Bitcoin in. But it depends on the price of Bitcoin at the end of the loan term. So I hope these examples gave you some insight on how loans can be used on Celsius and gave you some insight on the trade-offs between taking out a loan and using the loan to do different things. Both of these strategies come with risks, and it might be safer just to leave the Bitcoin on Celsius. And please be careful on how you borrow and how you invest. And as always, stay safe, and thanks for watching.